Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world. Today we are diving into FOXO technologies and their recent filing. It's a bit of a head scratcher at first glance, but don't worry, we'll break it down. Let's just say it involves some stock deals that might make your head spin, like trying to solve a Rubik's Cube blindfolded. So what's this Form 8K all about? Well, companies use it to tell investors about big, important events. Think of it as a corporate breaking news alert. In FOXO's case, it's about getting the go-ahead to issue a whole bunch of new shares. The key date here is February 27, 2025. That's when the event happened that triggered this report. That's the date a major stockholder gave their stamp of approval on some important decisions. Now let's talk about FOXO Technologies. It's a company incorporated in Delaware and their main office is in Minneapolis. It is traded on the NYSE American under the ticker symbol FOXO. Now they are considered an emerging growth company, which means they are still pretty new and have some leeway with certain regulations. This section is where things get interesting. It's all about a vote, or rather a written consent from a major stockholder. See, this one stockholder, called the majority stockholder, owns a huge chunk of the company, about 81% of the voting rights. That means they have a lot of power to make decisions. So on February 27, 2025, this majority stockholder gave their written consent to approve some actions. What were those actions? They all involve issuing more shares of the company's Class A common stock. Issuing more shares means creating new shares and selling them. The first thing they approved was issuing shares to ClearThink Capital Partners. This is happening because ClearThink is converting some convertible notes, which are like loans that can be turned into stock, and also exchanging some regular promissory notes for stock. The important thing here is that the amount of stock being issued could be more than 20% of all the company's stock that's currently out there. That's a big deal. Next, the majority stockholder gave the green light to issue shares to investors in a private offering, where they could raise up to $1,500,000. Again, the amount of stock issued could end up being more than 20% of the existing shares. Finally, they approved issuing shares to Jefferson Street Capital because of conversions of convertible notes and commitment shares, which could also push the total stock issued over that 20% threshold. Why is this 20% number so important? It has to do with the rules of the NYSE American Exchange, where FOXO's stock is traded. Specifically, Section 713 of their company guide. This rule says that if a company wants to issue a large number of shares, especially more than 20%, they usually need to get stockholder approval. This is to protect existing stockholders from having their ownership diluted too much, and that basically means that there's more pie to go around so everyone gets a smaller piece. In this case, FOXO is using the majority stockholders' consent to meet this requirement. Now there's one more step. FOXO filed a preliminary information statement with the Securities and Exchange Commission, or SEC, on Schedule 14. See, this is basically a notice to all the other stockholders, letting them know what the majority stockholder approved. The company plans to send out the final version of this notice to stockholders of record as of the record date. After 20 days after this notice is sent, the changes will become effective. So, what does all of this mean? Well, FOXO is essentially raising money and paying off debt by issuing a lot of new stock. This can be a good thing as it brings in needed funds. However, it also means that existing stockholders will own a smaller percentage of the company. The value of their stock could also decrease if investors don't like all the new stock being issued. Now, let's step back and look at the bigger picture. Issuing a lot of new shares can be a sign that a company is struggling to raise money in other ways. It could also mean that they are making strategic investments for future growth. FOXO is issuing these new shares to convert debt and raise capital through private offerings. This can be a good thing for the company because it reduces their debt but may affect the current investors. It's hard to say for sure without digging deeper into their financials, their overall business strategy, and the specific terms of these deals. Looking at FOXO, their financials might be an area of concern. The company is fairly new and still has emerging growth company status. The stock actions they are taking is a high-risk, high-reward decision. Ultimately, FOXO's success will depend on whether they can use this new capital to grow their business and generate profits. Thanks for watching. If you enjoyed, please subscribe, like, and comment.